Meantime, Fitch cautioning on those tariff risks for the Indian economy. The credit rater has kept India's sovereign rating at BBB-, not following that recent S&P upgrade. Fitch flagged India's high debt levels at nearly 81% of GDP and well above peers. It now expects growth to hold at around 6.5% next year, but also warned those new US tariffs of 50% on Indian exports could hurt sentiment and investment. Fitch says strong domestic demand and possible tax reforms could provide some relief, but high debt remains the sticking point for any ratings boost. The Indian markets, of course, coming online in about 40 minutes' time. Here's what the futures are indicating right here, right now as well. With regards to the open, a softer start expected, which would be firmly in line with what we are currently seeing playing out across Asia. So who better to give us a pulse check on the Indian markets and insight into the investment strategy on the eve of these brand new Trump tariffs? Mark Mobius is here. He's the chairman of Mobius Emerging Opportunities Fund. Mark, welcome to the program. Always great to see you, sir. So first of all, we have these brand new tariffs coming into place, 50% in the coming hours. Is India's domestic economy really going to be able to withstand the full impact of those tariffs? What's your take?
They will be okay. India will be okay, even though it will hurt some industries. For example, pharmaceuticals would be hurt because about 40% of pharmaceuticals exports go to the U.S. The garment industry, of course, will be hurt because a big portion of their exports go to the U.S. Jewelry, gems, that sort of thing will be hurt. So those are the three industries, I would say, which will be most hurt by these tariffs. But overall, we would see maybe 0.5% to 0.75% cut in the growth rate of the Indian economy. In other words, instead of going up by 7 or 6%, we might see 5.8 or 6.1 in terms of economic growth for India. So generally speaking, it's bad for India, but it's not disastrous.
Mark, stay with us just for one moment. I wanted to update our viewers on some breaking news. And one of our top stories today, we're just getting some fresh commentary crossing now from the Fed's Lisa Cook. She says there's no cause that exists for her to be fired and she will not resign. She also adds that Trump has no authority to fire her and will continue to carry out her duties. Of course, this is a major story impacting risk assets right now because what we have seen is Trump's threats to remove Lisa Cook really raising the alarm over central bank independence. Mark, while we have you, any thoughts on that?
Well, I think Trump will continue to push for lower rates. And I think there's a good reason for that. I mean, if you compare what the Europeans have been doing, the Europeans have been way ahead of the U.S. in terms of lowering rates. And I think the Fed has been much too slow. So in that sense, Trump is right. Now, the methods he's using to get his way is a big question mark. But of course, if she has, if Cook has violated the mortgage laws, then of course she should be prosecuted.
Trump is, of course, fighting fires on multiple fronts here. It's not just the outlook for the U.S. economy, but it's the ongoing trade and tariff agenda that he's leveling on the rest of the world, or at least those countries where he deems the U.S. is not getting a fair deal. And of course, India is a case in point. Mark, we were just talking about the outlook for growth there. Of course, you heard earlier as well that Fitch held off on upgrading India. Capital Economics also saying in the last 24 hours that GDP growth could slow by almost a full percentage point. You combine that with the GST changes that we're also expecting to see very, very shortly, and the outlook is looking increasingly complicated. Now, you just said that India can continue to grow through this. I want to know what that means for your investment strategy. What's your current thinking on how you're allocating around all of this risk?
Well, India is still very, very important for us. But at the same time, with these changes, we would have a lower weighting in India, but still India would probably be the biggest weighting in our portfolios because regardless of what you say, 5% growth is still incredibly high. And India's got an incredible domestic market. And more, you're going to see the domestic market taking over from exports and other growth factors in the Indian economy. So I believe that India still is in very good shape. And even despite these problems with trade with the U.S., which I think at the end of the day will be solved, they will come to some agreement and in some future date, not maybe within the next few weeks or months. Nevertheless, even with these high tariffs from the U.S., I think the Indian economy will still be doing very, very, very well.
Mark, you've been an India bull for some time now. I'm going to dig a little deeper into this to really understand exactly what it is that you see that so many others don't at the moment. Before we do that, what sectors would you say are most resilient to this tariff risk, and where do you want to be deploying specifically right now?
Well, of course, those sectors that are dependent on the domestic consumption are the ones you want to go to. Of course, if you're getting an exporter, obviously exporters are going to be hurt by these tariffs, particularly in the garment industry, in the gem industry, in the pharmaceutical industry. So these are the industries you probably want to avoid, unless you can find companies that are dependent totally on the domestic market, of which there are many. And by the way, one of the interesting aspects of India, of course, is that even without an export market, the domestic market is incredibly large and growing. I mean, if you're having an economy growing at 5 or 6%, that means that your domestic consumption is going up at a very high rate. So we would focus on those companies that depend on domestic consumption, and those companies that are quite independent of government regulation, which is another big factor. As you know, India is very big on government regulations and control. So this is something we have to look at very carefully.
Indeed. Back in June, you said your fund was holding around 50% cash, waiting for opportunities. Why so much cash in the middle of this apparent India bull market? And is that still the case, or have you changed stance since then?
We've actually reduced the cash. It's about 25% now. But thank God we've been having this cash, because with the markets at these uncertain terms, particularly India, we're being more cautious, and we have to be careful in putting money in. Of course, if prices of the stocks we like come down dramatically, we'll be putting more money in the market, because at the end of the day, we like prices that are depressed.
Of course. So how has the fund actually performed, specifically the Emerging Opportunities Fund, compared to MSCI MM or MSCI EM or MSCI India? What do your numbers actually look like?
Well, actually, we've outperformed the S&P US, which is the big benchmark, by about 1 or 2%. Not a big difference. But don't forget, we've been in business for only less than a year now, so it's going to take time for us to build a track record.
You know, I think it's interesting as well. I read a piece recently, Nomura, saying 41 out of 45 EM funds cut their India holdings in July. The country is the most underweight that it's been from a fundies perspective in several years. And then also, taking a look at this latest Bank of America survey, India went from top pick in May to least preferred in August. So what are they missing? Why are they swimming against the tide? Mark, you've been a bull for such a long time. Why is your view so different to what everyone else on the street is thinking about where this market is going?
Well, I think other people on the street are looking at China in comparison to India. And as you know, China is coming back. If you look at the China index, it's moving up. So I think there are a lot of people who say, I've been out of China. Now it's time for me to switch from India to China. I think that's what's going on. But I do think that this is relatively short-term thinking. At the end of the day, India is still going to do very, very well from a longer-term perspective. And if you look at the Nifty 50, it's still at a high point and probably going higher. You know, I can see the Nifty 50 going much, much higher than where it is now. And of course, once this trade war is over, you'll probably see a lot more good news coming out of India. By the way, one of the interesting aspects of this whole thing is that as a result of the pressure that the Indian government is having you're going to see them making more and more changes in the, let's say, the GST, the tax system, to make it simpler for businesses to operate. And there'll be a lot of reforms which will help the Indian economy grow at a better rate. Because a lot of things that are holding back the Indian economy, of course, is the bureaucracy and the complicated tax system.
So you're saying these tariffs could actually be a good thing because it would accelerate the domestic reform agenda, which would pave the way for what could be higher highs for markets. Is that the current thesis?
Exactly. That's what I think is going to happen. You're going to see the Indian government saying, uh-oh, we've got to make some changes to make our economy more efficient, make the government more efficient, make taxes easier to understand and to pay, particularly for the medium and small-sized businesses. So I think that's going to be a big change and going to be very good for the Indian economy.
Do you think the current premium that we see on the Nifty, and in particular the Sensex, which is trading 23 times forward earnings, is justified in this environment, though? A lot of people have been coming on the show over the last week talking about how perhaps Indian markets are looking a little stretched in this environment, given the current macro backdrop and, of course, the tariff threat as well.
Yes, as you know, most of the investors look at PE. PE is the big indicator. We don't think that's a very good indicator because the P is one thing, but the E is another thing. The E can move up very fast. And in India, you'll see some of these companies' earnings, the E, moving up much faster than the P, which means that if you're looking at PE, looking backwards, you're not looking forwards. So we would prefer to look at return on capital and other factors that show healthy growth and healthy companies with low debt. So I think you're still finding quite a few companies like that in India.
Hey Mark, was it a mistake for India to continue buying Russian oil? That seems to be the primary catalyst that sparked this fire in the United States that resulted in this higher tariff rate that's set to come into place tomorrow.
Yeah, I think it's possible for India to cut off purchases of Russian oil. Now it's an ego problem. I don't think the Indian government wants to be pushed around by the U.S. government, and therefore they would probably dig in their heels on this aspect. But even that, there's a good possibility that they will reduce their purchases of Russian oil. It's all a matter of price. As you know, oil prices have been coming down, and there'll be other sources where India can purchase oil. So it's quite possible that they would reduce the amount that they're getting from the Russians.
I think it's fair to say this has also lit a fire under Prime Minister Modi, a nationalist fire that seems to be carrying him quite well at the moment. Do you expect him to retaliate against these measures from Washington, and if so, how?
Well, he already has by stating clearly that he's not going to be pushed around, particularly in the agricultural area. I think this is very critical and probably a big mistake for the U.S. to be pushing on agriculture because it's such a very important part of the electorate in India. So Modi definitely does not want to harm the agricultural sector in India and therefore would not want to give in that aspect. But other areas, other industrial areas, I think he'd be willing to give in and to give a win for the U.S. in some of these other sectors.
Mark, just a few other points before I let you go. India's pensions now managing nearly $180 billion. I saw recently they've asked for permission to expand the remit here. They want to take more risk in gold and REITs. Do you think that's a smart move?
Definitely. I think they've got to have gold, particularly in India where gold is so critical. Definitely gold. And I think they should have a lot more freedom and leeway because equity is not the only game in town. They've got to go into fixed income and other areas. So I think their request makes a lot of sense.
And just finally, what's your advice to other EM investors out there looking for opportunities? If they need to rotate capital out of this market, maybe they're not as optimistic as you are, where can they go beyond India?
Probably other places in Asia like Taiwan, Korea, even Vietnam, Indonesia. All of these Asian countries are still looking very good. The problem is that in order to find the kind of companies that we're finding in India and in Taiwan, high return on capital, fast-growing companies, not easy. But I would suggest people look further afield in Asia, and particularly in Southeast Asia.
Mark, wish we had more time. We'll have to leave it there. Always appreciate the conversation. Looking forward to seeing you back out here in the Middle East very soon, sir. That is Mark Mobius from the Mobius Emerging Opportunities Fund. Thank you again. Up next on the program, more tariff talk as Trump hosts the South Korean president and warns China on rare earth magnets. All of the details on the other side of this break. Stay with us.